In June 2024, a rumor spread across social media that the 50-year-old petrodollar agreement had expired. For many, this signaled that a missing signature in the Middle East was about to reset their future mortgage rates and grocery costs. The fear is rooted in a 1974 handshake deal. U.S. Secretary of State Henry Kissinger negotiated a framework where Saudi Arabia agreed to price and sell its crude oil exclusively in U.S. dollars. The United States had recently ended the gold standard and was struggling with a severe energy crisis. Policymakers needed a new mechanism to ensure the rest of the world would always have a reason to hold and trade U.S. currency. This created a system of petrodollar recycling. Oil profits were routinely reinvested into U.S. assets, specifically Treasury bonds, essentially providing the American government with a constant, reliable source of funding for its deficits. By ensuring a steady demand for U.S. debt, this loop keeps interest rates lower than they would be otherwise. If that recycling loop breaks, the cost of borrowing for auto loans, credit cards, and mortgages across the United States would logically climb. The social media panic gained credibility when Saudi Arabia officially joined the BRICS coalition, a bloc of nations openly seeking to reduce their reliance on the American financial system. Almost immediately, Saudi officials signaled a willingness to begin testing non-dollar trades, exploring how to settle energy contracts with their Eastern partners using local currencies. While these geopolitical shifts generated headlines, the latest U.S. Treasury report contains a specific figure that contradicts the narrative of a Saudi exit from the dollar. Geopolitical statements often mask the actual movement of wealth. To find the truth, we have to ignore the rumors and look at where the capital is actually flowing on the global ledger. Part of this diversification involves Project Enbridge, a collaboration between the Saudi Central Bank and the monetary authorities of China, Thailand, and the UAE. This platform uses central bank digital currencies, digital tokens issued by governments that allow nations to settle trades instantly. This technology allows countries to bypass the traditional banking system and the U.S. dollar clearing network. This creates a blind spot for American oversight. If trade moves through these digital bridges, the United States loses its ability to monitor global money flows or use economic sanctions. Financial commentators often point to these untrackable digital tests as proof that the dollar's role in the global economy is ending. These technologies change the speed and path of a transaction, but they do not automatically change where a nation decides to store its long-term reserves. To see that, we have to look into the balance sheets. This Treasury data from February 2026 shows that Saudi Arabia's holdings of U.S. debt actually surged to $160.4 billion. The kingdom was accumulating American bonds at its fastest monthly rate since official records began in 1974. If this data-driven look at the global economy is helpful, please hit the like button so we can reach more people. The 1974 agreement has been superseded by a new strategic alliance. Crown Prince Mohammed bin Salman has pivoted the relationship toward a $1 trillion partnership focused on defense and high-end technology. The deal swaps the old focus on oil for new strategic materials. Saudi Arabia is supplying uranium to the U.S. nuclear industry, while the U.S. Department of War is financing a 49% stake in a Saudi rare earth refinery to reduce dependence on China. These minerals are the essential components for everything from fighter jets to semiconductors. The U.S.-Saudi nexus is shifting its foundation from the energy of the 20th century to the specialized supply chains of the 21st. The petrodollar system has integrated into a broader, multipolar strategic alliance. It is no longer a simple monopoly based on a single commodity. Saudi Arabia is now hedging its interests. They use digital currencies to maintain trade with the East, while simultaneously deepening their ties to the American defense industrial base through massive direct investments. This is a multipolar landscape. Emerging nations are strategically dividing their interests, moving away from a model where they rely on a single superpower for all of their economic and military needs. In this environment, the U.S. dollar operates as one of several competing options in a market, where technology access and debt yields are the primary drivers of value. When petrodollars were automatically recycled into U.S. debt, they acted as a predictable global shock absorber. Without that automated loop, the U.S. must now compete for capital on the open market. This means borrowing costs for things like car loans and mortgages will experience much sharper and more frequent swings. You should stress test your household budget to account for this new reality. personal interest rates are now directly exposed to the friction of global competition. Subscribe to stay ahead of these shifts in the global economy. And tell us in the comments, do you think the dollar's new role in this competitive market is sustainable, or will digital currency quietly replace it before most people even realize the shift has already happened?